target asset allocations are across stocks, bonds, real estate, private equity is tracking error bands or levels of active risk around each of those different asset classes. And we've learned a lot in the last few years about how tracking error has spiked up in some areas, how it's been relatively moderate in other areas. We want to take the opportunity to take what we've learned and update the targets, the proposed targets in the Statement of Investment Policy. Your strategist came up with an idea that I like. It's somewhat simple, but I think it communicates a lot of information to you, the board, and that is lumping like-type investment programs into a common tracking error bucket. And we use 3 different classifications. One, enhanced indexing. We're saying tracking error max target there would be 200 basis points. Semi-active would be 400, and then active would be 800. Again, I think there's some information that's communicated to you, the board, in terms of the types of managers that your staff and then the portfolio strategists will be bringing to you if they are enhanced, semi-active, or active. So it somewhat builds expectations of the types of managers that you might see across the different asset classes that we'll look at in a minute.
Have you seen this done anywhere else?
Maybe not using the exact same words, but yes, we have clients that use active and passive strategies and for different asset classes have significantly more tracking error where they think value added could be extracted, maybe in the small cap area, emerging market debt, or high yield. We have seen that, and it does make sense.
Let me ask, too, if you change the tracking error or expand it for subcategories, what impact does that have on the overall portfolio?
Yeah, it's a great question. The idea is that there is not an increase in the overall portfolio tracking error. That's not intended here, nor is I don't think Lee is seeking to do that. Right now, your ceiling is 400 basis points, and it's in our analysis, the pieces of the puzzle that he has to work with and that your portfolio managers manage, that 400 is sufficient with these tracking error limits in mind and the way the portfolio is brought together as a whole. Recall that these asset classes aren't all perfectly correlated, nor is the different types of active management that different firms bring to the table. So when we bring different asset classes and different managers that behave differently in concert, it should seek to diversify the portfolio, and that's exactly what the portfolio strategist has been seeking to do over the last year with some of the investments that he's brought forward.
Now, are we seeking to move to private equity and some of the private things too, or is this only for these listed?
Let's go to the next page, if you don't mind, and I'll show you what's on the table and what's not, maybe starting with what's not. This is not an exhaustive list of all the asset classes that you all invest in. These are the marketable asset classes, but what we're not showing is domestic equity, the developed U.S. and non-U.S., the global equity. We're not showing the asset allocation strategies or the relative value strategies. Those tracking error targets will remain consistent with where they were before. And just in case you're curious, the global domestic equity tracking error was 200 basis points. So that is considered an enhanced type strategy in the way that it's being implemented is being implemented in more of a passive and enhanced framework. The asset allocation strategy is an 800 basis point tracking error limit, so that's definitely considered an active strategy. And then the relative value category is 400, so it's in between in that semi-active range. Let me take the first 3 categories there, the emerging and then high yield. And part of this is what we've learned from experience, that how volatile those asset classes were during 2007, 2008, and even 2009. In 2008, we saw the high yield market decline by about 25%, and then it increased in value by about 53% during that time. Very volatile asset class. The active managers pursuing strategies also became incredibly volatile, and we saw tracking error across a universe of high yield managers. When we look at database of all active managers, we saw that tracking error balloon quite dramatically. And I took some notes. The range of returns for the 3-year period ending 2007 for high yield from the top quartile performer to the bottom quartile performer was roughly 9 percentage points or so. So a fairly wide spread from the best performing to the worst performing. When we move forward to 3 years ending 2010, so it includes 2008, 2009, 2010, that range from the top performing high yield manager to the bottom performing high yield manager was 28 percentage points. So a huge gap illustrating the higher active risk within that asset class.
Steve,
so we learned from that.
Just to, one of the issues with tracking error especially is that although it's a backward-looking measurement, you're using it to guide your forward-looking behavior. But because of the volatility that we experienced the last 3 years, is it your concern, or one of the concerns, if we don't change this, is that because these asset classes have moved so dramatically that we will be hindering ourselves by trying to use a history which is so volatile to guide our future behavior? In other words, we might cut short opportunities because the history which was so volatile will lead you to an incorrect result. If you were, for example, to take out 2008 and a lot of these tracking error classes and just go back historically for the other 9 years of 10,
Right.
then this wouldn't be necessary. So if you're going to include 2008, it almost forces you to widen your bands.
Well, you have to open your eyes and just recognize what happened in the marketplace and take that into account. I probably expressed it a little bit differently, that it might cause you to hire more index-like managers in the area of high yield and emerging markets, both equity and debt. And I don't see that as a good idea. I think those are
Right.
areas
Well,
where value
because you
can
would,
be added.
to hew to the index, you would have to get rid of any manager that wouldn't, because otherwise the tracking error of any active manager would automatically put them outside if you don't.
Correct.
Steve, I have to ask this question. If these are the right tracking errors that you are recommending today, then why weren't they put in place when we adopted the investment policy in March of 2010?
Yeah, great question. For emerging market high yield and emerging market debt, we just didn't have the benefit of being able to study all the data that we do now. We have another year and a half worth of data that we could look at, and lo and behold, tracking error blew out quite widely with those different mandates looking at active managers. That's the short answer there.
So it wasn't really what happened between March of 2010 and the present, but just the fact that you had not had a chance over the prior years to analyze the tracking errors?
No, I think it is the cumulative performance from 2008, 9, and 10, the period
10.
that we were looking at as well. We've had more data points to look at, and we may be coming back to you 12 or 24 months from now and rejiggering tracking error for individual asset classes again as well, based upon other experiences that we have.
Skip, and then Dan.
Yeah, I understand what you're talking about, but is the question really in front of us to maximize our flexibility to get the biggest return, or is it really to be a little bit more conservative and protect the fund? And that's an honest question that I want to ask you.
That's a great question, and I might answer differently for some of these different areas. So I would say for high yield and emerging market debt and emerging market equity, we're seeking higher octane managers. We want greater returns there, and so we want returns that are different from the underlying
index,
benchmarks.
yes.
From the perspective of the Treasury allocation, it is very different. That is a downside protection strategy by its very nature. The fact that we have 40% in Treasuries. We had a conversation earlier that Ms. Jacobs started with Neil Kashkari from PIMCO. Is that appropriate? Well, it's the insurance policy. It's the hedge that if there is a significant market problem like we experienced in 2008, that gives us our protection. We want the manager or managers, right now there's essentially one, that manage that portfolio to have all the tools in the toolbox or arrows in the quiver, whatever analogy you want to use, to be able to protect the system in a downside environment.
But, you know, history has shown that some of the managers out there, when they're chasing those bigger returns, take on risk that is really bad, and as a result, ultimately impacts us. And, you know, we've been through terminations and all kinds of different things. I mean, you're looking at anywhere from 2% to 4% increase, which seems like a pretty significant jump.
You know, a lot of it depends on the hands where you're placing those assets. And I have a lot of confidence. I know Lee, your portfolio strategist, and his firm has a lot of confidence in the managers that have been selected, that have been brought forward to you for approval, like Hoisington. You'll be hearing from Hoisington at the next meeting. They're a very skilled investment manager that uses that level of active risk wisely and appropriately.
Dan?
Yeah, I think that Skip hit it on the head. And when I hear a response that suggests greater returns, higher octane, I invariably layer in risk, more risk. And that is of concern. And I just want to extract assurances that we are not pursuing greater risk and I know about the Treasury portfolio, but on the other elements of the portfolio, it would kind of be awkward, I think, to thrust us backwards in time if we were to experience another tumultuous time as we just experienced. And we don't want to go there. So I'm looking for assurances and guarantees that this is not where we're headed.
So the question I just asked Lee is about one of their high-yield managers, Azov. It's been a long time holding in the portfolio. That manager can go short with some of its positions, being more defensive. That defensiveness causes a higher level of tracking error relative to an index that's all long. We don't think that that's a bad trade to make when it's in skilled hands. The same goes for Hoisington, that they can behave so very differently than the underlying benchmark that's used for that asset class in their own internal measurements. That's a good thing. In safe hands, this is why we built, Lee has built, the monitoring and the selection process of managers, and we bring them forward for your approval, et cetera, and then we monitor them on a regular and ongoing basis.
Well, and we would hope that virtually 100% of those that we would invest with are quote-unquote safe hands.
Right.
But history has shown us that's not always the case. So, again, the assurance, the guarantee that this is not where we're headed, and we're not taking on huge risk more because we want to protect the assets. We want to protect the assets of the fund.
Risk comes in two. Risk is around a central point, right? And it could be upside potential, could be more enhanced returns, or it could be downside protection as well, being different.
Lee?
Yeah, just to back up for a minute, because, I mean, I was the one that recommended the initial ranges to Steve and ultimately to the board that we set forth in policy. And I want to just kind of back up to what the intent is of having tracking error ranges in the context of an asset allocation strategy, and then talk about three different types of risk. So within the context of the asset allocation strategy, when I think of tracking error, and I am very dogmatic about this, the reason that I like to have tracking error bands in place is that it forces our allocations to be in line with what the underlying asset class is supposed to be. So in other words, if I'm allocating to a treasury manager, they're not buying emerging market debt, because that would undermine the intent of the allocation to the treasury manager, which is to get treasury exposure or natural resource exposure or domestic equity exposure, whatever the case may be. And that's one of the mindsets we have. Is the manager allocating within the opportunity set that we've given them to work with? The second aspect of it is, are they adequately diversified in the context of the underlying market so that they're not taking any idiosyncratic risk associated with a particular company or a particular credit, which is a concern of mine. I want to make sure that they have adequate diversification so that if any one company in the portfolio blows up, they're not having undue concentration risk associated with that company. So that when I think about, kind of broadly, why do I want a tracking error limit, those are two principal reasons and part of the mindset that we have when we created the policy. But the three risks, and this is what I think is very intentional, because people talk about risk loosely, and I've been doing risk management for the last 20 years, including building large systems to track risk. And when I think about risk, the three things I think about are what's commonly referred to as beta or market risk. And if you once you adequately diversify your portfolio, there's a level of risk that comes into a diversified portfolio that's not diversifiable. It has to do with how the economy moves up and down. And if you think about, growth and inflation are two big drivers of that risk. So that level of undiversifiable risk is something that we're very cognizant of. And when we think about each piece that comes into the portfolio, we think, okay, am I exacerbating the level of undiversifiable risk or mitigating it? And that's you're going to see that in some of the hedge funds that we recommend. And when we think about each atom or molecule as part of a bigger complex, which is your overall portfolio, you'll see that mindset. We think about the marginal contribution to total portfolio risk. But then the second framework for looking at risk is the total volatility of the portfolio. So I can have a 10% volatility, which is about what you have, which is in line with a 60% allocation to equities and a 40% allocation to bonds. Very commonly understood portfolio framework. People relate to a 10% annualized volatility. So we have about a 10% annualized volatility. But I can have a 10% annualized volatility that moves in the opposite direction of a 60-40 portfolio, or I can have a 10% volatility that roughly moves in the same direction of a 60-40 portfolio. We're a little less sensitive to the movement of equities than what most managers are, but we're still sensitive to the movement of equities. The third framework for risk is looking at it relative to each component of the fund's asset class as a whole. So when we talk about, a 4% or a 2% tracking error, all that means is that if a particular asset class is generating a return of, let's say, 10%, if I have a 200 basis point tracking error, 66% of the time, I'm going to be within 2% of that return of the underlying asset class. So I'll generate a 12% or an 8% return with a 66% confidence. I'll be within that range. So those are the frameworks. It doesn't necessarily mean that we're adding risk or subtracting risk as one risk measure relates to another. So I can increase tracking error, but simultaneously lower my sensitivity to the overall market. Or I can increase the volatility of the fund, but simultaneously, and this is harder for people to wrap their minds around, decrease my tracking error to the overall indices. So those three measures, market sensitivity, overall fund volatility, and tracking error, are all three independent measures. And what we're really thinking of is the cyclicality of the portfolio, whether we're increasing or decreasing sensitivity to the market, and how much overall tracking error we have once you consider all these moving pieces at the same time. But you're asking the right questions because managers cheat all the time. One of the reasons that we are pursuing more passive-oriented strategies within our equity portfolios is we want to make sure that our equity portfolios are domestic equity or are international equity, and that we have exactly the amount of emerging market exposure that we want. We don't want another manager that we think is managing developed markets putting a substantial portion of their portfolio in emerging markets and getting credit for skill when really the asset allocation is what's driving the returns and we're absorbing the risk. So I think these are the right questions.
Mark and then Doug.
So I just want to bring us back. The total fund risk, right, is not increasing.
Correct.
And through the magic of modern portfolio theory, right, we actually get to do that. And so I just want to make one point on this since we're looking at individual